Howdy, Jacob here. Today we're looking at AssetMark Financial Holdings in the capital markets industry. 2.5 billion market cap, slightly lower enterprise value. Again, provide wealth management around the U.S. Offers open architecture product platform as well as client advice, asset allocation, etc. Growth has been very impressive. Very impressive. Okay, so return on invested capital pretty low. Kind of surprising to me. Gross margin and operating margin are definitely lower than what I thought they would be, but this growth figure on revenue side is very impressive. Let's see if it's from acquisitions or not. Okay, so good amount of acquisitions, but even still, um, pretty impressive in the fact that gross margins are rising, operating margins rising, and they're making acquisitions. So that tells me that they're very likely making efficient acquisitions that are improving the efficiency of the business. 236 million cash-like products with 94 million long-term debt. We're definitely not concerned about that. Pretty balanced sheet. And cash flow, amazing. Takes nothing to run the business. $3 million in the last year, and they've produced 175 million. So very impressive free cash flow. Use of cash flow is pretty heavy on the reinvestment and acquisition side. Not paying a dividend. Yep, no dividend. Not paying a dividend, no share repurchases, debt, pretty much net neutral. So it's just all going towards reinvesting and making acquisitions. So good for them. Looks like they can get the return on invested capital. If they can push that up to that double digit range, that's when the business will really start getting a little crazy. But let's start making some assumptions on what we think this business is worth. On the revenue growth side, I mean, they're growing a lot through acquisitions, but even still, I'm putting that into consideration for this revenue growth. Let's say 10%. And for share change, let's look at that stock-based compensation, about 17 mil. It's about 1%. Or it's about 0.5%. So let's do 0.5%. And then for margins, free cash flow's been making money for a while. I love that. Earnings are starting to get there. So maybe let's do a solid range of 18 to 22. Terminal value, let's look at it is in the capital markets industry, that type of growth rate. Pretty low return on invested capital, kind of surprising. What if we just do 20, maybe 18? So this is saying at the end of 7 years, maybe the growth rate for the next 7 years after that will be more like 6%. I'm pretty comfortable with that 18 PE, share change, margins, pretty high on the earnings side, but you've definitely been increasing those. But again, through acquisition, I got to be a little hesitant because the terminal PE I don't necessarily want to base on acquisition unless they've been historically making very efficient ones, which they have been. So even still, I'm pretty good with these assumptions. And we're saying it needs to fall 31% to get to the return we're looking for here. I think this is a pretty great capital market company. I think that it's not doing a lot that the others are doing, but it's still doing a great job, growing very heavily. And I think definitely want to own it, but I want to own it at a great price. So I hope you enjoy the video. Have a great rest of your day. Thank you.